Hey traders, I'm James, one of the content team leaders here at A1 Trading, and as we start today's stream, I wanted to let you know about one of our show's main sponsors, FX2 Funding. With all the craziness going on in the prop firm space, we're excited to share some of the solutions FX2 Funding has put together for their traders. First, FX2 is rolling out DX Trade, which is a web-based trading platform that provides traders a smooth trading experience. It also looks super cool too, but that's not all. By signing up with FX2, you get access to C-Trade. C-Trade is a trading terminal where you can create custom indicators or download ones from the community. Get access to all of this and more by signing up for FX2. So, for traders looking to get funded, you can get 15% off by using promo code A1Trading15. That's A1Trading15. The link and promo code can also be found in the description. Now, onto the show.
All right, everybody, welcome back to another live stream. Hope you're doing well. It is Monday, and man, this week is huge. I don't know if you guys have looked ahead in terms of what's coming down the pipeline this week, but this week is absolutely monstrous in terms of what we can expect. We've got economic data, we've got earnings out of key companies in the United States. It is a big week. And we are back. Good to see everybody in the chat with me here. So I wanted to start with the S&P real quick, just talk a little bit about where the stock market is as we open up here this week. So the stock market had a bit of a slip to the downside recently. And I talked about this in my video that I put out on Sunday. Basically, that we put in this low, and now we put in a bit of a higher low, and now we've broken out of resistance. And bulls seem to be doing okay here. On Friday, you had a little bit of an indecisive candle on the S&P 500, but today we've started to already fill that that wick to the high side. Right now, I would say bulls look like they are in control, but there is a contention point coming up pretty soon for the S&P. I'd call it that 5140 to 5150 area here. On the SPX500, what we can see is we had past support that turned into resistance on the way down. We are now retesting that area. And the question is, are the bulls going to be able to bust through this level and go higher? Guys, I've had some changes to my own positions. I am now long the technology sector through the ETF XLK. I went long on this one. Well, I actually got assigned on my my puts that I sold. I got assigned. Now, the cool thing is that I got assigned right around the time that the market then decided to rip. So nice little position for me. I cannot complain about being up $2,000 pretty quick like that. But I'll talk more about that as maybe an easier way to analyze this is to take a look at the NASDAQ. So the XLK has very, very high correlation to just the Qs or the NASDAQ. And that's because, of course, the technology sector or the NASDAQ is comprised heavily of tech names that we all know and love. And so what we see here is that similar to the S&P 500, the NASDAQ also has a big test this week. And I'm very, very curious to see how price action reacts here. You got a nice push going into the market open here this week here. 9:30 just hit, so we are watching the stock market open up as we speak. The question will be today, are you going to get a candle that can break through this level, or do you see rejection off of this structure? I mean, this is really key stuff here because this was what really got us started to the downside. I think, and Frank and I were talking about this week, you are probably going to get some very decisive price action. You just have so many different things to look out for. On Wednesday, you have FOMC, obviously going to be a big market mover for everything, whether it be gold, indices, the dollar, etc. On Friday, you get jobs, right? So you got jobs this week, you got FOMC this week. And on Tuesday, I believe you have earnings for many of the tech names. I believe we have Apple and Amazon this week. I know that Amazon will be happening Tuesday after the bell. So really interesting stuff here this week as we get started. There's a lot to watch out for. How am I positioned going into this week? Well, the best way to talk about that is to maybe just show you guys my current positioning. So let's go over to the account. This is my real account, P&L, no nonsense. You guys know if you watch my live streams, um, one thing that I talk about frequently is my own current positioning, my own, portfolio, my own trading account. So I've got a couple different things here. I mentioned that I just got assigned XLK shares, and I'm very happy about that. I mean, the market ripping here this morning, don't mind that at all. I got assigned, so I collected premium on this. My average share price is 198.90. This is the technology sector. So similar to the Qs. I sold puts on SMH. That's also doing quite well. Another tech heavy kind of area of the market that is semiconductors. So I sold puts on semiconductors, and semiconductors ripped last week. So that play might be working out well. Also, I have an S&P position that I've also sold calls against. That one's doing very, very well. I have a silver long position that is also going well. Now let's get to the things that aren't going so well. On the TAN side of things, well, I've actually I've really come back on the TAN position. TAN, this is solar panel ETF or solar company ETF. It basically has a bunch of companies like First Solar, Enphase. You've got all sorts of companies that specialize in solar technology. So I sold puts on that. I got assigned, and I'm in the position. So got some mixed P&L there. And my worst performer is TLT. This is going to be a bond ETF. So this is 20-year plus year duration bonds that I own a position in. And this has gone terribly for me. So I've sold puts on this one. I got assigned, and then the market continued to tank lower. So with yields, let's have a look at yields and what they're doing here to the day to like the dollar, etc. If yields come down, that would be great for my TLT position and most of my technology positioning. I would love to see yields come down. That would indicate that Fed may cut rates, but I also am not basing my whole trading account or my own positioning based on we need to see rate cuts this year. I'm trying to avoid doing that, even though it would be good for a lot of the growth sides of the market. Again, I am looking primarily for stuff that is not incredibly sensitive to interest rates, which I know sounds a little bit silly considering I just talked about solar panels, bonds, growth ETFs, and obviously those areas have struggled a little bit more. Anyways, let's talk about gold here for a second. Gold seems to be finding a low point here. Here's gold on the 4-hour chart. You can see, let's go ahead and just take out this. This is really what we're looking at. We are chopping between two key areas. You have resistance around the 2,400 level. You have support around the 2,300 level. I'm watching to see if gold makes a decisive move one way or the other. Another area that's interesting, oil off of its lows, but not really moving too decisively either. Let's have a look at the edge finder. Oh, that's my email. You don't want to see my email. Let's go to my to the edge finder, and let's talk a little bit about top setups here today. So we got silver. Oh, hold on. I could hear myself for a second. That was weird. Okay, never mind. Sorry, where was I? I was talking about the silver market. I am still bullish on this. I still have a positioning on this one, or a long position on silver. We'll talk about that in just a second. Outside of that, let's take a look at other things. You got copper up here, silver, the Australian dollar against the Kiwi, dollar CAD, dollar yen. Did you guys see dollar yen? We got to talk about dollar yen for sure. The Bank of Japan has threatened yet again, or potentially there's a lot of traders, investors who are thinking that the Bank of Japan may intervene, which if you take a look at dollar yen on a price action perspective, my goodness, guys, did you see this move? This was a drop from peak here to the bottom. That is 567. Oh, that was James hitting a sound effect. Okay. I was confused by that. I was like, oh, there it is. See, we got sound effects behind me. That's awesome. So dollar yen, big pop, big drop. And one of the things here about the dollar yen, the story, I guess, behind this is that the Bank of Japan, and this has been an ongoing theme for for years now, really, is the Bank of Japan threatens intervention or talks about it. And I haven't looked at the specifics, but I believe from the headline that I saw that there's just rumors of intervention. I don't believe we've gotten a formal declaration of intervention from the Bank of Japan, but the rumor itself is enough to make the market think, oh, they're going to start dumping dollars, buying yen, supporting their currency. But we've heard this so many times. The last time it happened, it happened. It's happened several times. The last time there was a real intervention from the Bank of Japan, it did act to push the dollar yen exchange rate down for some time. We saw that back over here. Intervention from the Bank of Japan can have lasting effects. It's not always just a threat or always just a rumor. But what you have to understand is, the dollar is strong whether the Bank of Japan is intervening or not. In my opinion, the dollar looks really strong. And so for me, if this does give you a pullback, I am likely a buyer when it comes to the dollar yen. So I'm watching this one. I'm keeping an eye on it. I believe it's still neutral. Yeah, it's neutral on the edge finder here. But if we get something going here, we have jobs data this week. If you get something that crosses into stronger, economic data territory, if retail sales really beat out what Japan's putting up, we could see some interesting buy signals. But for me right now, dollar yen technically is still in the neutral camp here for me. So just waiting on that to see if I can find something. Let's take a look at silver also. I mentioned that I am long silver. So I have a position. It has done pretty much nothing. It's gone nowhere. It's really, really just been kind of a sideways mover for me the last several trading days. I'll pull up my SLV position. So yeah, I mean, we're floating $77. So it's not really moving anywhere. 77 bucks. We'll take it, silver itself will be likely very volatile this week because you have, again, a lot of economic data. The Fed will speak on Wednesday, and jobs data will come out Friday. So has the potential to be a really, really, really strong data. A lot of stuff could be coming out this week that could really move the markets. Let's take a look at the dollar really quick. So the dollar index, what I like about the dollar here, if I take a look at major currencies, we are still seeing, for the most part, a lot of dollar favoritism, and euro dollar is getting a very bearish reading. In fact, I think, I do have a position on the euro, but I'm curious how that's going here today. Flat on the day, but I am short euro USD. I'm just slightly in the red on this trade right now. But if the market rolls over, if data this week comes out strong or the Fed comes out hawkish, euro dollar might be a nice play. Alternatively, if they come out more dovish than expected, probably a stop out, right? So my thought though is that, when you look at the synopsis of the data here, right? When you look at all the economic data and most of it just coming out very, very strong out of the US, my thought process is, I don't think the Fed is going to get aggressive with rate cuts anytime soon. Now, the reason for that is you can look to a lot of different things. People are employed, right? Employment data by itself is one of the big factors as to why the dollars is getting such a strong reading on the edge finder right now. It's because employment data relative to its European peers and Pacific peers, the U.S. economic or the U.S. labor market looks really strong. And so that's giving preference to the dollar. At the same time, inflation is sticky in the U.S. So I just don't see right now a very solid positioning for, wanting to get really bearish on the dollar. So when I look at the U.S. dollar index, what I'm thinking for this week is if you do get dips, I'm probably a buyer around 105. And if you see breakouts, right, that's where I just let a winner run because I'm already in euro, but I'm flat on the trade. So we'll see what happens this week. But again, I lean towards, I think the Fed will stay more hawkish than what people think.
Pretty much in line with our expectations.
Exactly. The NASDAQ did come up. Oh, this is interesting. So the other thing I wanted to mention about the indices here today is that you have resistance right around this level. I talked about at the very top of the show. 5150, 5130 in that range is some really strong resistance for the S&P 500. And the reason I note that as being so important is that this area was kind of the last leg of defense, I would say, for the bulls when we were just seeing this straight up move in the S&P. We went sideways, and I pointed out, this is not necessarily bearish unless we break out this level. And sure enough, we did. We broke out of that level. You can see it on the daily candle. That's why I love the daily chart so much. You get a kind of a clear picture of what happened. So we had support. We broke through it. We retested that area on this wick right here, and then we went lower. So if sellers are going to take it from here, this is really their zone, right? If sellers are still around, this is their zone. Now, what I'll say about that is that if the sellers get beaten out, I think there is a solid chance we are headed back to the highs. Against all of my judgment of thinking that I don't think we're going to get a V up recovery, I will bite my tongue and admit defeat. Well, not defeat, because I'm bullish on the S&P, but I'll admit that so I'm cautiously bullish. Let me clarify my positioning when it comes to the indices right now. I'm cautiously bullish. I have positions on it. I just think that there's a justified reason for this market to be a little bit concerned with the higher for longer mandate that I think is going to be reaffirmed this week. The point is, I think the stock market has reason to be a little concerned and maybe to take a chill pill, to pause for a little bit. So does that mean I'm bearish? No, it just means that I think we probably go sideways or we head back and test the lows. And I don't think that that's necessarily bearish. It's okay to say, and I've made this point on my channel many times, it's okay to be bullish on something and still think it's okay or normal for it to pull back or, correct a little bit. So I am still bullish on the S&P and the NASDAQ. I'm very, very bullish on these things for the rest of the year. Whether I'm right or wrong about that will be seen. I'm bullish on the stock market, but I think it's very appropriate that we do see a pullback, and that, I think it's very normal if you do see this thing roll over and retest these 49.50 lows, or perhaps even test the 48.50. We could see that, and people, could be blindsided by that event. But again, where I think I have to say, nope, this market's going higher and just bite the bullet, is if we break through this level with decisive price action. If we get a big solid green candle, perhaps on Amazon's earnings tomorrow, that's where I just say, okay, V up, right? Most likely. So we have two scenarios watching the reaction of this level going into this week. You have many catalysts. The market will pick its favorites, and we've got to see how that goes. So what does that mean for gold? Somebody asked about the thought process on gold in regards to if you get some hawkishness from the Federal Reserve this week. This is my point with why I'm not long gold right now. All of the stuff that I just said bodes pretty bearish for gold. Because let's reiterate what I mentioned. Higher for longer means rate cuts might not be coming as soon as people thought. But the economy is still relatively strong. That's what's stopping the rate cuts, is people are employed. The consumer is relatively hanging in there, despite what everybody, obviously the grocery store is a shell shock for all of us, but people are still employed. People are still paying their bills. People are still buying stuff. They're still traveling. As long as that is going on, rate cuts are going to be hard to find. And if rate cuts are hard to find, what that tells me is, okay, gold up in these areas is just not as attractive as it was over here. That's my opinion.
I cannot buy that.
I cannot buy that. Exactly. There's a quote from our friend Tom from Simply Forex. So gold coming down here and retesting this area, I think that this is also a very normal correction, a normal pullback. Now, what could get you, what could get me excited about gold longs again would be as if you saw the ECO, the economy, start to cool off a little bit. At the same time, if inflation, which has been a sticky problem, if it stays problematic, this is the stagflation argument that we don't currently have right now. This is why I'm not outright bullish on gold right now, is because right now what you see instead is you see the economy actually doing pretty well against our traditional metrics. Jobs, people are employed, inflation is remaining hot, arguably because people are employed and because people are spending money. And inflation is also sticky. So this environment is not necessarily outright bullish for gold, because what this tells you is that the Fed has a back pocket play where they can actually rate hike if the economy is really strong. So the picture for gold is just not as bullish for me. I have to really remain patient. And you guys know me. I love to buy gold. It is one of my favorite plays, just to be long gold, find opportunities to buy gold. But I'm not a perma bull. I'm a trader, right? So as a trader, I have to be willing to acknowledge there are times where I'm sitting in and there's times where I'm sitting out on a market like gold. So I'll wait for a signal when it comes to the metals. On gold right now, we are just getting a very neutral reading, and most of the red in this chart is coming from strong economic data, as I mentioned. In the Edgefinder scoring algorithm, guys, the economic data being strong for the US is considered a bearish signal for gold, and the economic data being weak for the US is a bullish signal for gold. That is how we've calculated the scoring system for the Edgefinder. By the way, if you guys have not picked up a copy of the Edgefinder, our 45% off sale is coming to a close at the end of April. If you have not picked up a copy, do not miss out. This is the biggest discount that we do all year long. We've just dropped a link here in the chat for our viewers that are with us here live. If you speak with us while we're live streaming, that's how you can get that 45% off discount. It is the biggest discount that we do all year long. And just to reiterate, if you have not heard about this sale event, we do it every year in April. This is basically a 2-year celebration sale that we're doing. So we launched the product 2 years ago. We've built so many different metrics and indicators and tools for traders who are trying to incorporate fundamental analysis into their to their trading. What this tool does, it really does a couple different things. It pulls all the data in automatically for you. It finds it all over the internet, builds this report. Number two, it makes an easy to understand report on the Edgefinder. So the Edgefinder, you can look at NFP data in detail. You can hover through it. You can parse through the data in an easy to use, all access, one platform. That's number two. But number three, and what I think is my favorite feature of the Edgefinder and where we spent the most time, is on our end, we have all this data in here. Okay, cool. Now take that data and decipher how each piece of data impacts a particular symbol. Is this bullish for this? Is this bearish for that? Is gold are institutional money buying silver, or are they selling silver? Are they buying the pound against the dollar? You know, we can get this data in here, and that's one thing, but then making the Edgefinder think through the data, that is where we excel as a company in building a tool that has been incredibly useful for generating bullish and bearish ideas based on not technical signals, but predominantly economic signals, as well as seasonal signals, as well as sentiment data like the commitment of traders data. We go a step further than anybody else. We interpret the data using a system or an algorithm that we have built in-house. If you guys would like a copy of the tool before the sale ends, again, click this link, chat with a representative on our staff, and they'll get you hooked up and answer any questions you might have about the tool before that sale ends. Again, that is the biggest discount that we do all year, so don't miss it. It's coming to a close. There it is. Very nice. All right, so yields. Let's talk yields for a second. Are yields going to come down? Well, what do you need for yields to come down, and why does this matter? Well, if you trade gold, you should have this watch list. This should be on your watch list, 110%. If you trade gold and you do not have US10Y on your watch list, add it. I'm telling you, it's worth it, because what this is the bond yield offered on US government bonds. Okay. And this number goes up when the bond market thinks that inflation will remain sticky and or the economic outlook is positive. When the economy is really positive, what people tend to do is they say, okay, I have options. You know, think of people building their They have options in their 401k. Let's say, 401k people park money in their 401k, or they stuff money in an investment account. This is the majority of normal people, not people who stare at charts like us all day long. They have a couple options, right? They can go into something like stocks, or they can go into something like bonds. And I've made this point many times, but when the economy is really good, right? Where do you think people go? They don't really go into bonds. They go into stocks because companies are doing well. It feels right to buy companies when the economy is doing well because earnings are going to grow and people feel they're going to get a good return. But if the economy is bad, they flip the script and they say, no, 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 stocks are doing terrible. Companies are performing poorly. Let's go into safety. Let's go into bonds and just collect basically guaranteed risk-free money. That's the idea behind treasury bonds out of the United States. Now, there is risk involved with anything and everything in the markets. And the idea that there's no risk in bonds is foolish, but it's what people think. They think, oh, just go into bonds, that's safer. So the point that I'm trying to get at, though, is that when the economy is doing really well, people typically do the first thing. They don't buy bonds, they buy stocks. And again, right now we are in that environment. So what we see yields continue to creep up and up and up. And the reason for this is because the bond market is an auction house. They're auctioning off debt from the US government. And people are saying right now, nah, 4% is not going to do it. We need 4.6. And if that keeps going up, what that usually signals is that, again, inflation is expected to be sticky, that the economy is doing well, but inflation's sticky. And what that can lead to? That can lead to eventually stock earnings becoming really unattractive. And people say, oh, nope. And they rush back into bonds. This is a fascinating thing. And if you're somebody who's watching gold and you're like, well, what does this have to do with me? Absolutely everything. Because gold trades very closely to what this is doing. If this is rising, this is not a very good time and an example to do this right now because it's not gonna be perfect. But most of the time when this is rising dramatically, people get away from gold because they say, the economy's looking really good, inflation is sticky, and with those two combinations, the Fed can just raise rates, and all of those scenarios are poor for gold. Now, if this thing were to drop dramatically, it can lead to some really great performance in gold because people are flooding into safe havens, and that would be gold, and TLT is another one, right? Bonds in general. So think about this when you're looking at this. Also, the dollar index trades very closely to the yields market as well. If this is rising, typically, not always, but most of the time, the dollar index is also rising as well because, again, this is the confidence level in the US economy. If this is looking really strong, then people say, yeah, I want dollars, right? The dollar is so much more stable than other currencies. Give me the dollar. This is what people are thinking when yields are on the rise. Okay. So right now we've seen yields on the rise. And so people are very excited about, the strength of the US economy. So they're seeing this thing go up. But the longer this does go up, again, it poses a threat at some point to stocks, because at some point the risk to going into stocks is not worth just this risk-free 4.6%. Think about this, guys. And a lot of people have been pointing out this, and I'll be talking in just a moment to Chris Pulver, and we've had this conversation together a couple of times. Maybe we'll ask him about it in a moment. If the bond market, if this continues and we go up to 5%, you got to start thinking that psychologically, people are going to start saying 5% risk-free. And when I say people, I'm not talking about just people like you and I off the street. I'm talking about like pension funds, people who manage tremendous amounts of money. They start looking at that and they say a 5 handle on a 10-year government bond that's risk-free 5%. That's not bad, right? And you got to think there's also tax benefits there. So there's a huge incentive at 5% for people to go into bonds. So where I see some trouble for the stock market would be if you continue to see this thing move up. That's where you get inflation concerns continuing. You get people going into, looking a little bit differently at bonds as an option. Again, you got to think bonds might not be very attractive when they're offering 3.8 to big money managers, but at 5%, you got to take them seriously. So these are things to really think about. Same thing with gold too, by the way. I want to add one thing. Why are yields up not putting pressure on gold? I know somebody thought about that when I mentioned it earlier. Well, one unique and beautiful thing about gold is that it has a very low correlation to other traditional investment assets like stocks and bonds. It's not exactly correlated to anything. And many people, and I've heard this argument, I thought it was a good argument. A lot of people are looking at stock market and say, this thing is really high. Many people are looking at bonds and they're saying the government's just printing a bajillion dollars. I don't want to put all my money in bonds. And so perhaps gold is also up because people are just looking to get away from some of the traditional assets that many people would argue are looking overbought. Sometimes gold just offers that alternative investment class that people like. By the way, remember, guys, I pointed out this level on the NASDAQ, 17,900, 17,800, somewhere in this range, similar to the S&P 500, these zones that I've got marked up. I'm very curious to see how price reacts to them as we approach today. Remember, today or this week is a stacked week. We have jobs data, the Fed, we have earnings for big tech companies. It's a huge week. Real quick, before we bring in Chris Pulver, I just wanted to showcase the COT data. Here's the latest weekly filing. We can see gold, the Nikkei, oil, silver. These are the most heavily bought or proportionally longed assets by institutional money, according to the CFTC's non-commercial commitment of traders data. At the same time, on the bearish side, you got the Swiss franc, the yen, the Australian dollar, the Canadian dollar, the Kiwi dollar. These are your proportionally bearish things. On a long-term basis, as I always mention with this, the net positioning, this table right here, is best for long-term positioning, 6 months plus. Now, if you are an active trader, here's the good stuff. This is what you really want, is the latest weekly filing, which shows money flows in or out of a particular symbol or security. So when we look at this week, we see on a net percentage change basis, which we have the calculation outlined on our website, a1trading.com/edgefinder-tour. Take that. It's a free course on our website if you'd like more information. Again, a1trading.com/edgefinder-tour. It's a really, I worked all weekend on it. Okay. So please open up the page and, give me some feedback on it. I'd very much appreciate it. So let's go through this really quick, and then we'll transition to our next portion of the show. So the Nikkei, copper, silver, South African rand, Australian dollar, USD, CAD, the Russell, the 10-year government bond, Bitcoin, SPX, gold. These are all assets that saw varying degrees in descending order, buying overall or bullishness overall. Okay, let's flip it around. Let's now go ascending bearishness. Kiwi dollar, US oil, the NASDAQ, some selling there. The yen, some selling there. Interesting, especially going into this week where we saw some intervention concerns. The euro, platinum, the Swiss franc, the Dow Jones, and the pound. Pound saw the most selling out of all of the things here listed on the screen. Again, remember, you can get access to this report before the sale ends. It is 45% off using the link being dropped in the chat now to speak with a representative on our staff about our software tools. If you don't have a copy, pick it up. It's our biggest discount of the year, ending very, very soon. Okay, guys, now what we're going to do is we're going to transition. We're going to bring in Chris Pulver to the conversation in just a moment. Before we do that, we're just going to thank our sponsors who make this show possible. We'll be right back after this.
Attention A1 Trading Show fans, if you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker Eightcap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to Eightcap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
All right, and we are back with Chris. Hey, Chris, how's it going, man?
It's great, Nick. Happy Monday, man.
Good to have you back on the show. And again,
Thanks.
I was prefacing today that this week is huge in terms of market potential volatility. You've got everything from FOMC on Wednesday, jobs Friday. I believe it's Tuesday we have Amazon after the bell. And is it Thursday that we have Apple after the bell? I mean, you got earnings and everything. Yep. I mean, it is a crazy week. What's your high level view of this week as we get into it?
Yeah, it's exactly that. It's expected to be super volatile. I mean, we're wrapping up a month. We've got 913 companies reporting earnings. We're kicking off with the Fed on Wednesday, non-farm, like you said, on Friday. So I've got some notables right here. We also have a lot of semiconductors, and I mean, again, this is what's rallied the market a lot this year. Let's just take a look at some of the notables. Bitcoin as well. We're going to have some correlations there. So MicroStrategy today aftermarket, that'll be a big one to watch. Coinbase is later on in the week. Coinbase is aftermarket on Thursday. We also have Tuesday, a little fintech with PayPal, some consumer, I mean, I don't know if Coca-Cola is probably a blue chip just because of dividends and it's lower volatility. McDonald's, health of the consumer, good or bad. Eli Lilly with Ozempic, one of the bigger crazes. So it hasn't been semiconductors, but Ozempic has been Eli Lilly's bread and butter there for this big epic rally it's had. Then we get into SMCI, which actually was one of the top performing stocks in 2024. Just came out of nowhere, shooting up like 200+%. And then it joined the S&P 500. So SMCI likely to have some volatility. That's Tuesday after market. AI, it's in the AI space and semiconductors. Advanced micro devices, same thing. Amazon, like you said, aftermarket on Tuesday. Riot is a Bitcoin miner. Pfizer for big pharma. MasterCard Health, the consumer. We talked about Visa last week. Barrett Gold. I still don't think that the miners have really caught up in any way, shape, or form. Like gold mining has not caught up with the actual spot price of gold. And I don't know if it's the best trade to be long miners, even though it's like dirt cheap and value wise, it seems to be where the catch up trade could be. But anyway, just thoughts on that. Let's see here. Thursday is a big one. A lot of the earnings this week, Nick, are going to be Wednesday and Thursday. I went to my calendar update here. So let's go to where a majority of the earnings are coming out will be Wednesday and Thursday right here. So we have 274 companies.
You got Apple on Thursday. So that's a big one, obviously.
Yep. Thursday after market. So 274 on Wednesday. And this is all going to be digested during the Fed. So it's 2 p.m. Fed rate decision, which is pause is expected. 2:30 press conference with Powell. Thursday, after market with Apple, 318 companies, which is most of the week. So literally Wednesday, Thursday is dumping in almost 600 companies of the 900 reporting. So you have 2/3 of the week just on Wednesday, Thursday alone. So yes, needless to say, it's going to be a very highly anticipated week. So I'd like to get into the charts because I still think let's look at the NDX, for example. So if you go to the weekly time frame, a couple things happen with these Fed weeks, right? The NDX had such a massive sell-off 2 weeks ago that I could still see, even with the Fed this week, that we could have high volatility, but we don't necessarily do any damage to that previous sell week, right? Last week was a recovery. Last week kind of stabilized. I still think this is a high, low, lower, high, lower, low scenario from the technicals. But I don't know if we're going to push and make fresh lows this week. It's going to be nuts, man. It's going to be something that's difficult to position for, and it's going to be so fast and so furious that I was telling Frank offline that, typically with a big earnings week, I'm pretty excited about getting in some strategies that I can, go long straddles, long strangles, reverse iron condors. I can trade some volatility breakouts. But I think that these moves are going to be so fast that I don't necessarily want to pay a bunch of money for debits and then have to be, jumping all over the place to manage these positions. So what I think I'm going to try to do is look at a more cost-effective way to tackle earnings and go in the money, do some credit spreads, try to collect 70% on the dollar premium. And that way, if we have an earnings move that's beyond expected or right around my expected move, I should be able to collect, some net profit regardless and take a very small risk. Like for me, I could grab, let's say 70 cents on the dollar, risk 30 cents. I lose one, win one, walk away positive by maybe 20 to 40 cents.
Yeah.
So
what's interesting, Chris, too, is I think that this week, when you have so many things around the corner, like constantly, what that would lead me towards in terms of a bias would be if you see a profit, take a profit kind of environment. Because again, when you have the S&P popping big on Amazon earnings, or let's just say, if Amazon blows it out of the water, it pops open on the next morning. In my personal opinion, just just from watching how, the markets will, there's such a 24-hour news cycle.
Yep.
On that next day, you probably sell that. You get out of the way of the Fed meeting, because again, there's probably correction, there's probably profit taking, there's probably a lot of, kind of resetting throughout the week for all of these big events. So I think that's tricky, because I think the follow through will have a little bit of shadow of a doubt everywhere it goes, just because you've got so many potentially market moving things that could whipsaw things back and forth. So should be a really interesting week. I would say, the biggest one in is probably going to be the Fed. Because the Fed, here's what I'm thinking with the Fed right now. We've just had so much more evidence that rate cuts are going to be hard to come by. The jobs
Yeah.
data, we do get more of that on Friday. You had PCE last week was hot. The issue that I see is that the market is wanting cuts, and even the Fed themselves wants to cut rates at some point, but we're just not seeing the evidence of that. And the market is getting short term all hyped up on tech earnings, which I do think is, a very important, that's going to be your leaders. But if the overall story is higher for longer, and we continue to see that theme, at some point the market's going to wake up and say, oh my goodness, so rate cuts are really not coming until, September, but maybe even past that, right? Do we even see a rate cut this year? That's look at the trend. The trend is not in your favor if you think rate cuts are coming in September. But we'll see.
Yeah, and speaking of the rate cuts and the forecast, I mean, it's interesting that the Fed's kicking off May 1st with here's the tone we're going to set for probably the rest of Q2. I am curious if Powell takes the initiative and kind of sets the tone for the rest of the year. I know every Fed meeting, every press conference, he pretty much talks out of both sides of his mouth, and we will cut if we have to, we will raise if we have to, blah blah blah. And the market's like, what do we do? So here is September. This is what the CME watch tool or the Fed watch tool is looking for. This is probably the thing that I would watch for the closest by the end of the week to see how big the shift is in expectations. Because right now, Wednesday, 97.3% chance nothing happens. That's very likely the case. It's probably you could forecast that and say I am Nostradamus and I'm predicting that the Fed won't cut rates because it's pretty much baked in. And then going into June, also 88.4%. That's probably not going to shift too dramatically. July, summer trading, also probably not going to change. September, this is what I'm talking about. It's 44% that there's still a sliver of a potential rate cut coming in September. I still don't think that it makes sense to cut in September and then have an election within a couple of months. So that's why this is probably what I watch the closest, because if this all of a sudden shifts where by Powell's messages this week, let's see if September has a big shift. And if this is down and this is up, then we are definitely kicking out the thought of rates until probably 2025. And that I don't think is going to bode well for the stock market as far as tech, as far as small caps. I think it's going to be struggling. That being said, we have to remember that the SPY and the Qs, they are market cap weighted. And when you have market cap like an Apple, like an Amazon, now an SMCI that's come out of nowhere to be one of the best performing stocks of the year. You got Nvidia up there as well, which came back in a big way last week.
Oh, huge. Yeah.
Those stocks are big enough and they are volatile enough and they move quickly enough that can still drag the markets higher or at least stabilize the sell-off. So I think traders need to be aware that because it's so concentrated at the top with literally 5 stocks or 10 stocks, just because we have higher for longer, we could see that the broader market, like the S&P 490, is underperforming while the top 10 still perform well. And that's what 2023 looked like with the recovery.
Yes, exactly. And I think Chris, you've outlined kind of where I am most bullish. And I think that if I could show you this chart here for a second on the S&P. So my thought process on this is we're coming up to resistance here. But as you've mentioned, I had to explain my positioning because it's kind of complicated. I am bullish, and you know it well. I am bullish overall, but I think that there was some good merit to this sell-off. Again, I think the market does not want to believe that rate cuts are not coming as easy as they think. So that's a big story. But what's bouncing it back here, and what I've pointed out as my line in the sand here, is this level on this SPY, the S&P. if 5150 gets broken out, and let's just say it's Amazon earnings or whatever it is, at that point, we may be seeing a V up recovery. My basis for this is I'm bullish, but I don't think a V up recovery is what we see. That's been where
Right.
I've been at. But we've got higher lows here. We've seen, breakouts of market resistance levels, and if we continue to see that pattern, at some point, I probably just say, "Hey, this thing looks strong." That being said, though, again, we got to break out of this key level, and this morning so far, this level's been pushing back a little bit on the Nasdaq and the S&P 500. Also, Chris, I want to get your thoughts on gold here. Gold's had a big run up. And as you were joining the show, I was pointing out that arguably one of the things that gold might be traveling up on is clearly not just, yields, because yields have been up. So, one of the things that I've been thinking about for gold is perhaps there's just this desire to diversify from big money into something that's not so correlated to everything else. One beauty of gold and, um, silver is that it has the potential to be less correlated to other assets and does typically go up over time. So is there this push for a move into gold, not just from US investors, but perhaps foreign investors, foreign central banks? Is there a desire to get away from the dollar? What do you think?
I mean, I think that's what was the secret little run that we had on gold this whole year. Was a lot of it was it's central banks that are buying gold like crazy. It is definitely a slight position away from the dollar. Again, this could be a very odd year where gold is up, dollars up, equities are up, yields are up. I mean, that's one thing. So when you took your TLT position, I did the same thing. I'm long TLT, but I'm out to 2026. I'm trying to give this market plenty of time to
Hmm.
then kind of right the ship. And so I jumped onto the session and caught your discussion around, what would peak investor interest to get kind of out of the traditional equities run and go more into a fixed income safer play. I mean, if we
Yep.
look at, I could log into my Schwab account and take a look. I'm pretty sure right now you can still get certificates of deposit, money market instruments, and treasuries for over 5%. And the treasuries probably have the biggest shift. If you're willing to lock up money and make it's illiquid, but if you lock it up for, let's say, 12 months, you can still pretty easily get a 5+% return for, it's not risk free, but it's as good as it gets as far as taking very, very low risk on these trades. And
Right.
for 12 months, I mean, I don't mind locking up capital for 12 months and having it be, illiquid for that period, but getting 5.5% yield. So let me log into Schwab. So we're looking at gold right now. Nick, do you have a technical spot that you like on gold? I'm kind of waiting a little bit longer to see if gold will maybe play a slight pause a little bit longer. I'd like to see if gold can just kind of hover in here, maybe try to create a couple of floors that I could buy from, as opposed to just thinking like this is the dip. I don't think that this is necessarily the dip. If we came a little
Sure.
bit lower, I can wait for a trend line break. But this is why I'm not in a hurry for gold, because I like silver better. We've talked about it. I like the technicals
Mhm.
on silver more. I think silver has more upside potential as a percentage. But if
Yep.
we can establish some good structure on gold, let's say that this, 2275 is all of a sudden getting, tested. Well, then I get long at 2275 because I have the evidence to do so. But right now it feels like one pause, I'm getting back in. I'm not in a hurry. I'm not in a hurry considering silver is such a better technical trade for me.
Yeah, and I've made that point, 5,000 times, but one of the big reasons I like silver too is because it has more of a industrial demand. It's actually used
Yeah.
in like everything. Whereas gold, it's really that risk, that safe haven kind of material. So I like silver too. I think that if you're going to see this environment where you have high inflation but also strong economies, I'd prefer silver over gold. If you see something shift where the economies are sliding but inflation is sticky, that's where you'll probably see me jump right back into gold. So I'm kind of watching that story pretty close on that front. Another one is oil. Oil has come down off of its recent highs around 87.50. So we have seen a bit of a pullback there. Oil is an interesting one to keep an eye on, guys, because remember that oil, even if you don't trade it, it's an incredible indicator for inflation, right? Energy costs, transportation costs, shipping, all of that stuff. Whether you look at the core CPI or just the CPI, right? The core CPI, it makes an effort to strip out energy and food prices, which are volatile. But if oil remains high, even when you use the core CPI, this still factors in, right? It still trickles in because everything costs money, and prices will go up if oil prices are high. So even if you're just looking at the core CPI, trying to say, oh, I just want to see inflation on like, key things, oil can be very impactful to the overall story for inflation, and it's something that the Fed can't really control, right? If oil prices are flying high, that can present a problematic story for the higher for longer scenario. So keep an eye on oil. It's really important to the markets. Right now we are seeing a bit of a bounce off of this 81 area. Chris, you and I talked about this last week. You think this has room to push back up and retest this 88 area?
I do. I'm pretty bullish on oil's posture overall. I think if oil, as long as we stay, to me, as long as we stay above 77.50, I'm still pretty bullish on the structure overall. It's surprising that oil hasn't gone up faster and higher with all the stuff going on in the Middle East right now. But I mean, 81 or $80 on the nose might be a little. I think that gets tested, right? If we have a little pullback, we find channel levels, we might breach this level for a fake out. That could be like the bear trap, and then this rips back up. But like I said, to me, if we're invalidating this bullish channel, to me, this is price coming back below 77.50. So I don't see that happening. I think oil is still really well supported around this $80 handle. I'm looking to retest the highs. I think range wise, we go all the way back up into the 90s again. You'd mentioned the core CPI too. The one thing that also is a very sticky part of inflation and just high costs is shelter. I know shelter's lagging, and I know that trends are showing, lower shelter prices, but housing wise, real estate wise, people aren't going anywhere. I mean, I think there's less moving. Rates right now are still sitting above 7% for the 30-year. And yeah, I mean, if oil goes up, it's going to be hard. And then the conversation, I think, shifts where it's like, is it a hike? Is the Fed going to hike to really like just squash this altogether because they're going to throw another 25 to 50 basis points out there? I don't think the
Right.
Fed wants to hike. I don't think the Fed wants to cut. I think the Fed is like fingers crossed that nothing breaks. They have to come back in and do something like intervention wise. Speaking of intervention, I'm sure you talked about the yen this morning, right?
I did briefly. Yeah. So
Yeah.
so you had what are your thoughts on that? Obviously, big swings both directions here.
Yep.
My quick opinion, Chris, is I think that we've seen this story so many times. The Bank of Japan comes in and they say, oh,
Yep.
well, I don't even think they said anything. I think there's just rumors, right? There wasn't a formal
Sure.
announcement. I think it was
Sure.
just rumors of dumping dollars, buying yen kind of stuff.
Well, this is so I looked at it this morning, and it still doesn't really change my opinion. I mean, yes, we had a 500 or 600 pip swing just today with all the yen crosses, and that's ridiculous volatility. And again, it goes what we keep talking about. You can't plan or trade around that. Like the spike to 160 happened in a minute. The spike all the way down after that happened within 15 minutes. We've had such a ridiculous amount of volatility in such a short amount of time. For the traders last week, they're like, they're going to intervene. It's like, well, how do you position for that without getting stopped out in a flash crash type move? And
Right.
not only that, but in 2022, when we did have actual like statements from the BOJ saying they're intervening, right? And it happened 3 times, and it happened over like a 6-month period, and it didn't put the high in. It's like we had a high right here that went up another 500 pips. Then we had another high to low and another high to low after the fact. That was end of the year. So if this is maybe step one of the rumor of intervention, it possibly doesn't take shape effectively. And I'm still here's where I'm proven wrong. If I'm dead wrong on this yen stuff and the BOJ is intervening to a huge degree, then we're talking about the dollar yen. Nick, you and I would see the dollar yen down here and have a conversation about selling and seeing that the Japanese yen is truly getting stronger and now it's time to start looking at position for sell trades. But if we have just a giant indecision candle for the week and a lot of volatility, price can trade inside that for days and days and days ahead where there's not a high or low broken. We just have a 600 pip range this week.
Right. Yeah, for
Yeah.
sure. I mean,
So it's tough.
totally. Yeah. And I think that for me, it's just the pattern of, the theory around yen or Japan intervening in the currency exchange. Historically, it's just like, it's just been bullish. Like
Yeah.
it's a bullish environment. You would think it would be the opposite. That's what everybody thinks. And then you get these blips and they get bought. And then oftentimes they're just back to the highs pretty quick. So,
Yep.
for me, I think that dips on the dollar yen until proven otherwise are are mostly bullish. The story for the dollar just looks really strong overall. And I don't think that the Bank of Japan can change that factor, right? That's not something that they can control, is the strength of the dollar. They can try and help their own currency. But again, until broadly speaking, I'm more bearish on the dollar. The dollar yen looks pretty attractive to the upside in my view. Chris, I just want to thank you for coming on really quick. I'm going to let you keep taking over the show for a little bit. For everybody who's hanging out with us, Chris comes on the show regularly. He contributes. He also takes over the show for a little bit. So stick around here. He's going to be going through some more charts, going through his own approaches, strategies, stuff that he's trading. So before I step out, I just want to say to anybody who's listening here live, Chris has his own YouTube channel. We're going to drop the link to that. If you'd like to check that out for yourself, you can subscribe to his channel. He's also got a Discord channel that you can join for free, all that good kind of stuff. Chris, thanks very much for taking over the show. You got it from here.
All right. Thanks, Nick.
All right. See you, man.
Bye. So we'll wrap up a couple thoughts on the dollar yen. I do think that there's your high, there's your low. It's a lot of crazy volatility. I still think that the dips are being bought. If I'm structurally going to change my outlook, so here's the deal. I have robots running that are buying only. So Aussie yen, CAD yen. I'm not trading the Swiss yen because it's safe haven. I'm staying out of that one. But Aussie yen, CAD yen, Euro yen, pound yen, New Zealand yen, dollar yen, all my robots are buying only. So the way that works is my alignments on my systems and strategies have to get buy trades. Pullbacks like this are actually good because that offers my robots a chance to either see a transition from what would show a short-term sell signal. It's not selling. I'm not interested in selling, but a short-term sell signal then becomes a confirmed buy signal, and it buys again with stop losses below that recent U-turn. So if we see that all we're having today is this high, this low, and prices trading sideways, my robots are going to get realigned with buy signals and look to see if we can keep making higher highs. Now, a couple more things on the yen. If we go back to a weekly or monthly chart, 160 is an interesting spot. That there's a high back in 1980, and this is nuts. Okay, but let's look at this from the technicals because this is what I think we have here. This is the high from 1990 at 160. Okay, if we breach 160, there is really nothing stopping the dollar yen as far as major structure. There's nothing stopping this thing until 177. Now, I get it that maybe the round number at 165 or the round number at 170, these can maybe stick and be like a level of, intervention. But when you look at this chart, this is an open space above 160, and there's nothing until this 1978, it's like a 1978, 1979 low. And that's at 177 or 176. So there's still plenty of upside potential for this carry trade to keep happening. And I do think the Bank of Japan is in a rough spot. The Nikkei 225 could benefit from a weaker yen, but it's forcing investors to be in equities. It's forcing investors to be, pretty much anything they can do to get yield outside of a weakening currency. And it's a tricky and delicate spot. But I also look at this from just simple technicals. This is a textbook head and shoulders. This creating a left shoulder, head to neckline, right shoulder. We had this large buildup of the right shoulder for months and months and months, almost years actually. And I just want to measure this because this is what I'm looking at, and this is why I'm not stopping the trade. If we're going to go up, this is my low to high, okay? And there's two ways that I measure this. We can measure this to symmetry right here, which lo and behold, the intervention that we saw at 152 was right around that symmetry level at 150. Okay, so that was a measure move just from a low to high, higher low to higher high. But the true measurement of a head and shoulders pattern is from the neckline. Okay, so to me, this is a technical pattern in a currency in the Forex market, which is super technical. And we have 175. So I'm not predicting or saying that it goes to 175, but I am saying that from my analysis, it makes sense if we do get to 175. And for me, if I was going to say, Chris, where do you think the dollar yen stops going up? I would say 175 to 177 because 177 was a previous low from 1979 or 1980, and 175 is a measured move from this perfectly obvious technical pattern. So if I'm going to call a top, I'm giving this thing room to go another 1,000 pips to the upside, maybe more. And if I'm going to call a top, I want to see that we have a topping pattern emerging and we want to be on the right-hand side of the trend line. Neither of those have happened right now. So to me, I am in no hurry to say this yen thing is unraveling, be long the yen. I think that's a terrible decision right now because we're going to see it, intervene and then probably be bought and slowly drift higher and make it more painful for the retail traders that are fingers crossed. They get like that first little like sample of hope that it's like there finally. I mean, yeah, it feels great if you're right in, once in a blue moon with the trade finally going your way if you're upside down in these crazy drawdowns. But those drawdowns to me are just going to get worse. If you're holding and trying to fight the yen, good luck. And that's the scariest place to be as a trader. If you're fighting and you're waiting for a central bank to be your savior, no thanks. So this is why I'm not doing anything other than trade what you see. I've got robots positioned for it, trading very small. And to me, technicals, 175 to 176 is where I would say this is where I could predict and forecast a technical reason for the market to stop going up. And that does not mean 160 is the spot that I say this is the top. So I think there's more upside potential. I'm going to stick with it for right now. Okay. Really quickly, when Nick was on the show, I was talking about I brought up my Schwab account here. I want to show you just some fixed income plays. Right now, if you are looking at, what, I don't want all this volatility. I don't know what the market's going to do, good, bad, and different. If you're willing to tie up, these short-term certificates of deposit, the little money market instruments, you go to a major bank, go into CDs, getting a 12-month right now, you go out, 12 to 18 months, 5.45%, virtually risk-free. Yes, it's illiquid, but, going out 2 years at 5.4, 12 to 18 months at 5.45, it's slightly off that. I mean, the crazy thing is even a 3-month. I mean, a 3-month that you would just buy back into, the 3-month is 5.45. I mean, that's not too bad. If you are in a position right now where, and this is probably for the older, the older investor or those that don't need to take a bunch of risk or needing to take a bunch of risk. If you want less exposure, then you can play it safe. You can go to the larger banks right now, go to the fixed income vehicles, do the certificates of deposit, money market instruments, do the treasury route, and every 6 to 12 months, it's a pretty good deal. I mean, since 2023, I do have a portion of my portfolio, fixed income wise, like Roth IRAs and traditional IRAs. I have about 20% of those sitting in CDs and sitting in money market instruments and sitting in treasuries to be safe, and then the rest are in some stocks that I'll hang on to. But anyway, I mean, it's kind of nice to know that, look, the average return for the S&P is 8%. That 8% is going to have to face probably a 20 to 30% drawdown at some point. Traders are freaking out that in 2024 we saw the market pull back 5%. It seemed like the sky is falling. This is nothing, right? I mean, this market pullback that we've had is absolutely child's play. And this week with all the news and all the earnings and all the Fed speak, I mean, I don't know what the market's going to do. If I had a crystal ball, we'd position for it. We'd all make a bunch of money together. But what I do feel I can do is I can say that this high to low, if we're going to cap this retracement, we're probably looking at this 51.45 or 51.50 level. And from there, if this market respects that as resistance and we try to make a lower low, then this becomes a nice technical channel to then look for what's next. Well, this level's where I'd be way more bullish on the market. If we come back into 4850, 4800, retest those all-time highs before we broke the all-time highs, retest that level, to me, that's where I could say, okay, now we've got a, close to double-digit correction. It's going to be like 8%, and that's healthy, right? 8% correction, that's 8.25%, give or take. That's a healthy correction in a bull market. We should see, 3, 5, 7, 10% corrections. Any deeper than that, yeah, gets a little bit scarier. If it's double digits, it's a little scarier. But 5%, 7%, 8%, those are healthy corrections. We hit right around that 5% level here. So from all-time highs to there, that's about a 6% correction, just shy of that. And the market is doing what it can to stabilize and fight back. Now, with earnings this week and the Fed, I could see this being a very noisy week where, stocks individually like pop up, pop down, good, bad earnings. I'm not sure. Right. I mean, I can talk through an earnings play, and like Amazon's a good one. Frank, you're on here. What's up, dude?
How's it going?
Good, man. Anything you wanted to talk about in particular?
Yes. So I am looking at Amazon.
Okay.
Earnings.
Yeah.
I know we already talked about it, but I guess just for the audience,
Sure.
I'm looking for a lot of volatility in this stock. I don't know if you talked about the big tech earnings already, but we saw Microsoft and Meta and Google all either move 20, 50 points in either direction because of earnings.
Hmm.
I'm sort of looking at the same sort of deal with Amazon. So like if we look at Meta, that was a big AI trade.
Yep.
Seeing that miss was a huge move for the stock. I think did I say Microsoft?
Yeah, you did. Microsoft and Google were the
Microsoft
big
and
ones last week that kind of stabilized the market. Microsoft beat earnings. They beat expectations top and bottom there. And Google was the one that ripped up the fresh highs. Google, that was a huge, I mean, that blew through what I expected to see in Google from a 156 all the way up to 170. We're fading that move a little bit, but that's a big, big gap on Google.
yeah, I'm looking at heavy volatility this week because of
Yep.
that,
Yep.
and because of we have the Fed talking on Wednesday too, and I was gonna ask you what your thoughts were on that, just in terms of what do you think he's gonna say. I already have my ideas, but I kind of wanted to hear what you say first.
Sure. I mean, I think Powell is the ultimate like articulate craftsman. I mean, he will say that it's the same thing we've seen it very consistent, right? I mean, he'll talk about um, where inflation data is at right now, where the consensus from the Fed is at right now. If it's necessary to raise, it's not off the table. Is it necessary to cut? What's the timeline? They're still figuring it out. I mean, it'll be all incorporated into the speech in his press conference, and the market's going to have to determine what direction they think is a better way to go. Here's what I'm looking at now. I'll just again, let's keep it on the charts. I mean, one thing that's really interesting is if you look at unusual options activity or look at like high open interest strike levels going into Wednesday, for example, and this is all potentially going to change as more contracts get thrown in the market. But if I go to Wednesday's expiration, since we have all the indexes now with single day expirations, and then Friday is going to be a big one since it's the end of the week. May 1st, what I thought was interesting is looking at the open interest here. Look at where these levels are at. Right now, it's showing that we have way more call open interest than we do put open interest. And some of the strikes that stand out to me, and again, this is just for Wednesday, but the strikes that stand out to me, 515, which is exactly, if we go back to the chart here, look at 515 on the SPY. It's right here at where that floor was established, that 513, 514, 515 level. If that's tested and then reacted to, so open interest, in my opinion, is either a magnet or it's a slingshot. So if this is going to be what kind of absorbs the move and then slings it lower, I could see 515 acting as major resistance this week. If we go back into the open interest, so we have this 515 that stands out to me, then we have this huge level all the way up to 520. 520 could certainly be tested, but 520 also does not get us to all-time highs, right? 520 is this
Right.
great recovery, good effort on the SPY, good effort in the broader market. Earnings could be positive to support that move, but 520 does not get us to the all-time highs. And so 520 could also be a spot where good effort, but not good enough. And then we start to fade back down. And it looks like this: high, low, lower, low, right? Where it's a close move, but we just have more volatility and chop at the top, which from a technical standpoint would make a lot of sense if we started from a low, had this crazy 5 or 6 month run with virtually no pullback, and the market just takes a break, just takes a little bit of a breather. So I mean, I would like to see this, Frank. I'd like to see that the 513, 514 level on the SPY offers some resistance, just because technically that makes a lot more sense as far as high, low, lower, high, lower, low. Once this correction, if this correction plays out, this gives real buyers, this to me, this gives real buyers, longer term buyers, a much better opportunity to position for that. So
Yeah,
that's what
I
I'd like
agree.
to see happen. And so I think it
I
gets more
when
challenging. Yeah, go ahead.
you talk about 515,
Yep.
that's also around this 50-day moving average that I've been looking at too.
Okay.
Um, I would say like 5150. That's sort of like the top for the week for me, or at least in the short term. I think Powell is definitely not going to say anything dovish, but if earnings also come out less robust than what we thought. I think
Yep.
that's also going to add it's going to add volatility either way, but I think this is going to add to the bearish side. I think those calls you said expire on Wednesday, right? At
Correct.
5:15.
Yep.
See, that's a tough one because you kind of want more time for that, I think. If you're trying to get a call and see price of the SPY hit 5:15, you'd probably already want it to be there if it expires on Wednesday. So, um, I'm just saying it's got resistance. It's got the 50-day. Last week's rally isn't an indication that there's going to be a whole lot of upside, really.
Right.
And I'm not necessarily hoping for a huge correction, but it's hard to be convinced of a extremely bullish rally, especially when yields are still at 5% or just hovering just below it. And, there's just a lot of uncertainty around where yields are going to go. So,
Agree. And I think that, the market's been pretty resilient considering that we have this rally. I mean, yields have gone up and they peaked at 5%. That's when the bottom was in the markets. The yields have gone up. We've barely pulled back off those all-time highs. So the trajectory that the market has sailed when this retreated and we saw the October bottom in the stock market and the yield top right here. The fact that the market took that and ran all the way to fresh all-time highs by another, 11% to start off this year's trading. Yes, we faded that back down to about, 3, 4, 5% net. I think now the market's up about 6 or 7% net for 2024 year to date. But I mean, yields are going to continue to probably retest this level. And I see a lot of macro analysts out there talking about, 5.25 to bring the 10-year up to where the Fed is sitting. I mean, the Fed's sitting at 5.25, 5.5%. So if real yields get up to that point, I mean, the thing that's breaking people's brains right now is how can we have yields up to 5.25, 5.5% or making these highs and see the equities market still being as resilient as it is. And this is what I said earlier to Nick. It's probably if it's this case where the market really hasn't sold off a lot, it's because so few stocks are just keeping it supported. It's still the Apples. It could be now Nvidia. It could be the AI space. It could be like the concentration of 10 stocks that floats the entire 490. So there's
well, yeah,
resiliency in the market, which is kind of nice to be an investor, but it's like if any damage is done where let's say this week with we have what SMCI. Okay, this is going to be a play here where this could be one that I look at. I know there's earnings this week. It may be a little risky to take this trade, but if I went low enough, let's say I went out like 30 to 45 days, Frank. If I went low enough and I said, look, I think that this won't come back to this level because SMCI might be in the same situation as Nvidia, where hardware wise or what they do, what they're offering to the markets, what they're getting into this AI space and this AI race. Maybe this is where, a 50% pullback is a justified move to the upside. Maybe. At the same time, why would I be skeptical of this? Because when you have a parabolic run like this, it's nice to see that the market can actually retrace. So this might go what goes up and it might work its way down, but we might talk about SMCI all the way back to where we started this breakout. And then we're stuck here like, what about this AI stuff? And is it a bubble? So I'm just going to be careful on how I position and kind of chase this stuff. So, like I told you earlier before we jumped in the session, I think I'm trying to keep my costs low, my debits low. I do expect a lot of volatility. And I mean, I'm just going to set a bunch of chart alarms. I think that if you take trades kind of day to day, or like if you position for today to Friday, you've got to be ready for a lot of volatility come Wednesday. I'm probably going to take individual earnings plays, trade the SPY and the indexes alone on Friday, and then try to position for something for the week. So as we're talking about this right now, I was actually going to put this trade in today. So I could possibly revisit the 48.20 if it gets filled. That'd be another big. Let me see if I can get this trade actually. So there's two things I'm looking at. If somehow this market's going to rip this week and try to retest these highs, that's around 52.70. I'm going to put in a broken wing butterfly at 5,300 and try to get filled for. It's the SPX, so maybe I could probably get filled for like 75 cents or a dollar if the market's going to come up here.
to end the week, you're saying one
And
week out.
this has nothing to do with where I expect the price to go. What I'm looking for is if the market's going to do anything to the upside. Okay, I want to see if my credit that I can get on a broken wing butterfly will actually get filled, I don't want it to get to that price. I want my price to be safely out of the way to
No,
collect
I'm
my income
saying,
for the week.
is this something you're looking for to expire Friday?
Absolutely, yes. So this would be a
Okay.
5/3 expiration. So I'm going to look at this right now, and I had it pending in my platform. It's trading for nothing. It's trading for 5 cents. But if I sell the 5,300, buy the 5,295, buy the 5,310, here's what I'm going to do. I'm going to go in to I did not take that trade yet, so I'm going to put this trade in at a net. I'm going to try to get. I mean, 50 cents is like low because I think if it threatens, it could possibly do a 75. But I'll try 55 cents. And let me see if I can get this one filled. So
Would
I
it
will
be
do
a negative value too?
so it depends on the platform. So my platform here for Tasty, it shows credit down here at the
Okay.
bottom, so that I can just type in 55 cents and label it as a credit. And a lot of platforms you list it as a negative because it's a debit is positive, a credit is negative. But in this one, it's already positive just because it's listed as a credit. So I'm going 55 cents net credit, good till canceled. If this doesn't fill and I don't get the credit, no big deal. It just expires on Friday without a fill. But if my SPX rallies, through that 5150 level or 5160 level, maybe test that 5200 level, cool. I could get filled at 50, 55 cents because we'd have, changes in deltas, changes in values for all these option contracts. And I could possibly still collect that 50 to 55 cents by the end of the week. I'll know
Okay.
more probably post Fed on Wednesday. I don't know. Right now, I'm probably saying this has like a 10% chance of getting filled. We're at a 2 delta, which is extremely low probability of getting filled. In order to get my 50 cents, this probably has to be like a 10 or 15 delta, which is not even close to that. So we need to see price shift quite a bit. That being
Yeah.
said, I still like the level. If I get the income, I'm certainly going to take it. So I'm going to position for it right now in my portfolio. And then I want to look at the NDX for the same thing. And I'll look at the SPX above and below, because if I did the above strikes where I'm looking to sell up here, I'm going to look to also surround this. So if I can do a, broken wing butterfly here, broken wing butterfly here, I think that's far enough away that price is right in the middle. And so I don't necessarily see price breaking the highs or getting all the way back down to these lows. Therefore, I could possibly get credit on both sides. Does that make sense?
Yeah.
So I'm going to try that. I think that's a good play for me. The SPX, it stays out of the way, gives price plenty of movement to run. For the week, if I go to the weekly expected move, weekly expected move is around 120 points. So that would put me up to, let's say, current price. 120 points is well off the highs, and 120 points is not even at the lows. So if we do the average, I'm well within those means to make money on both sides. If we do, let's say, double that, if we did like a 240 point move, then we're probably going to talk about flirting or testing. 240 points to the downside, that still doesn't get me all the way back to 48.50, which is where I'd position my my long put butterfly spread, and also to the upside here at 53. That one's going to be closer because we're threatening right now. If we did 200 points, that's close, Frank. That's 183. I think that'd be a good butterfly trade, though. I could easily get my 55 cents there.
It's just very much out of the money
It
that
is. It is. It
what
is.
are the odds that you even get filled and even at 55 cents if
Slim.
it's trading at 5 cents now?
Yeah, slim. Slim. But that being said, if we have a, Amazon, and all of a sudden we're talking about the SPY up here, I still have plenty of time left in the trade to collect the income, maybe. And so here's what I'm doing. I'm not going to adjust my numbers to just get filled on the trade for the purpose of getting filled. I'm going to keep the trade where I think if I want this trade, this to me is where I'm safely out of the way. This is where I'm safely out of the way. I know that if I really wanted to get filled on the trade, I've got to take 5 or 10 cents today. Well, I'm not going to take 5 or 10 cents. There's way too much risk on the trade. I pay all the fees for a 4-leg trade. It's just going to cost me more money. So, if price goes up and I get filled, cool. If price goes down and I get filled, cool. If I don't, it's okay. I can still look at this intraday. I can still look at the NDX as well. But this is how I'm going to start the week. If I'm willing to go out to Friday, I don't need to force trades. There's going to be plenty of stuff that I can trade this week with all the individual stocks and earnings reports, plus the Fed, that I don't need to be forcing a position. So I already have a trade on for the NDX today. That's looking pretty good for full profit. I had a bunch of profits last week. This is 17,970. So if we stay below this, that's a easy dollar credit today. and then I have nothing for the rest of the week. But this is another one. I can do the same thing on the NDX. I'll go up here and look to do a broken wing butterfly with the long call side, and then down here with the broken wing long put side. I don't care if price doesn't fill me right now, but if it goes up and threatens, I get filled. If it comes down and threatens, I get filled, and I still keep that little lottery ticket on the broken wing. So that's going to be my safer plays for the indexes this week. You and I will talk all week, I'm sure, offline. I can price out some options for us as well. Amazon. So if we go into, didn't we talk about this last week offline, where I showed like what the expected move was? Let me look at our chat.
It was what was it? 15. Around 15.
What did I calculate here? AI 930. Okay, so that's this week. NDX calls. Okay, Amazon. Oh yeah. So about a $15 expected move. So we've had 8 out of 10 of the previous earnings reports on Amazon have hit the expected move of at least $14.90. So we're looking at, we're trading at 180.61. Positive rip for Amazon puts us up probably to fresh highs. We're not quite at all-time highs yet. Amazon's gotten all the way up here towards 189. But what's kind of nice about this is we stalled at the all-time highs over here. If we have a positive print on Amazon, we could certainly breach those all-time highs. But similar to what we did in Google, Google just blew through those all-time highs. But look at how it breached and then it's starting to fade. So I could see Amazon doing the same type of thing where, we test the levels, we get to that $14, $15 move, and from 180, we go to 195 or 200, and then it fades back down. So I still like it. I still think we position for it. It's not an expensive trade at share prices at 180. There's ways to trade that. So if I look at Amazon and I want to keep it super cheap, let's go to, and here's another thing. Amazon is Tuesday after market. I don't know if I can just go out to Friday. If I wanted a little bit more time on Amazon, I might want to go out to the 10th. So let's find out. So the expected move would be about 14, 15 bucks. If we're trading at 180, let's say that I did like a 192. That's inside of the expected move. But if I did an in the money bull put spread in 92.50 to 190, so on a 250 spread, I could get $1.80. This is definitely in my wheelhouse for what I'd like to do on Amazon. So if I collected $1.80 out of a 250 spread, I'm collecting 72% of that premium. That to me is a low risk, cost effective way of taking the trade. So $1.75, $1.80. I don't mind that trade. If I did that on both sides, that's a deep in the money bull put spread. We're at 180 right now. If I did the 170, okay, I could collect 350 out of a max $5, and that should be right around 70%. So if I collected 350.
So you're making these verticals basically in the hopes that by May 10th, the price has moved outside of those.
Yeah, and I don't even need it by May 10th. If this happens to be the move on Wednesday morning, if we're coming into Amazon Wednesday morning and Amazon is out here, or Amazon is out here, for me, for the
like 1, 2, I don't know.
Yep. So if I did a 360 credit, okay, and right now, if we come into Wednesday or Thursday's price action on Amazon, if price is out here or out here beyond my strikes, one of these credit spreads is going to be in the money and winning. Okay. And so my 362 credit. So here's what I likely won't have. I won't keep the full 362 by next Friday, not this Friday, but next Friday. I'm not going to wait that long. If price goes outside of these levels, which is what I want to happen, what I could probably do is close this for like a 262 debit. And then I can keep $1. So I mean, if I put 362 in and I walk away with $1 net profit, I'm still pretty happy with that. And there's no way that I have to wait until May 10th. All I need to see is, can we get a $14, $15 move? If we do, easy. I did that on Netflix. I did that on Meta. I did that on Tesla. There's easy ways to trade these where with expecting good volatility and probably getting it, you can see here that the market's expecting a 14.50 move, right? You want to see what the market's going to charge you. If you want to be long on Amazon, so I think this is probably how I'd play it. It's cost effective. It doesn't cost, I mean, my risk is $1.50 for, if I risk $1.50 and I walk away with $1, I'm pretty happy with that. I can obviously try to play it a little bit more greedy and maybe try to get an extra $1.50, $2 out of it. But this is realistically what I think I'd end up doing on Amazon. If we did a long option, let me delete this for a second. If I just buy the 182 and I buy the 180, right now you are paying the exact amount that the market's expecting to move. 1454 is the debit to go long at 182.50 and long at 180. That's a call side. That's a put side. The expected move in the IV is 14.59. You're paying that exact amount. So if you want to be long on Amazon, the way you make money on this trade is you need Amazon to blow out earnings and have a big expected move, one way or the other. You want to see Amazon move $20, because if you're going to spend $14.50 to make 20 bucks, at least you walk away with $4 or $5 net credit. I
Right.
just don't love that you're paying for every penny of the expected move, and so I try not to do that. Although this is not that expensive. I mean, heck, on Spotify, I paid $21 and made $1. I mean, I made $10 rather. I paid $20 to make $10. That was still pretty good. But to pay 14 and make 4 or 5, still okay. But that requires Amazon to go beyond the expected move. And so the way that you and I talked about earnings is I'm always trying to look at how can I safely calculate this to go the expected move. If it blows through my expected moves, that usually works in our favor. So even with the credit spreads blowing through the expected moves works in our favor. Doing a long trade like this is a long strangle. If it blows through those levels, works in our favor. But here's where it gets tricky. If it doesn't go $15 this week, let's say Amazon only goes $8, $9, $10. Well, I'm not able to cover the cost of my trade. So I'm immediately going to be looking at this trade like, oh crap, I overspent. I'm not getting the move that I wanted. Now I'm going to have to wait. I'm going to have to wait and see if price over the next week and a half will get to that $15, $16, $17 move to get me to break even or better. Or if it actually goes $20, then maybe I get to my profit level that I want. But typically with earnings, I'm not trying to hang on to them that long. I try not to.
Yeah, I don't like strangles or straddles
Yeah.
because, like you said, it is the exact expected move pretty much. So
Correct. Yep.
you have time working against you too. It's probably not the best thing in the world. You got to do something like credit and debit spreads.
I
But
agree.
yeah,
So
I'm wondering about the SPY though.
yeah.
By Friday,
hmm
I do you really think that price has the momentum to test the highs or get close?
Here's how I think it's possible. Okay. Despite what the Fed says, look, we've seen the market this year come out of the gates. It doesn't matter what Powell says. He said zero things different, right? December, the market took it as a pivot because they're like, well, we're going to cut rates and we're looking to, watch inflation, but we're going to cut rates. And the market loved it and ran with it. And then they started to talk it down and say, well, we might be higher for longer. We're going to be higher for longer. Market has not responded to the Fed with negative price action. Not really. So here's how I think it's possible. Look at this list of companies with 900. I mean, we've had like 60+% of companies report earnings. 80% of those earnings have been printing and beating expectations on top and bottom. I mean, we have enough market cap this week between Eli Lilly and I mean, MicroStrategy is not massive, but it's a Bitcoin related thing. There'll be plenty of volatility there. But let's just talk big, right? We did the Mag 3 or 4 last week. Tesla's kind of been tossed and burned, but we had Amazon this week. We had Google and Microsoft last week, but we have Apple. We have the largest company in the world market cap wise with earnings on Thursday. If Apple blows out the water and we have a big move on Apple, that alone has the power to move the entire index. So if you have, let's say everything this week, consensus is earnings are positive all week. It'd have to be a kind of a perfect storm of earnings just crushing it this entire week, and Powell just kind of stays out of the way, doesn't try to jawbone it down. But between all these companies with all the hype of AI, so you're looking at your SMCI, your AMD, you've got Amazon as well, which is a Mag 7. But whatever, I don't know what people are calling them now. You've got Apple on Thursday. Yeah, I mean, I again, anything is possible. Here's what I'd like to say. We're starting out the week at the SPY. Let's talk SPY. The weekly candle right now is tiny, right?
Did you see Tesla?
Did I see Tesla?
Have you seen it recently? This morning it
Yeah,
opened up
I know.
pretty high.
I know. I mean, in Tesla, I mean, I was in with a 142. I was in a 142.50 long, and it got up to 165 like the day after earnings. I took my profit. This was a credit spread that I did. We grabbed. Let me see what I have my equities on demand. I think we ended up making Oh, fudge, where is it? Here's my spreadsheet. Equities on demand. I mean, Tesla's crushing it right now. And I think, and look, it's not because of earnings. I mean, if you look at the earnings report, if I go back to the daily, Tesla actually missed, right? We had a
I
miss
don't
on
think it
earnings
was
per
the
share
earnings
and
move.
revenue, but it was the thought of they're looking to release. The positive news that the market ran with was they're talking about a $25,000 electric vehicle coming sooner than later, maybe later by the end of the year. And so, I mean, that could be one of many things the market's like, that sounds good, I'll buy that. So, and also it was so beat up and so bearish. I think that it was just overly positioned bearish for Tesla. So I think this is a short squeeze, in my opinion. I'm not ready to go long Tesla. It'd be nice if I was long. If I was long Tesla at 140 and it's trading up to 180, that'd be freaking sweet. But I just don't think I'm not in a position to be long and want to stay long. I was
Yeah.
looking at still around this $100, $90 level. I was going to show you one thing on, what do we do on Tesla? I think I just pulled up the
We did that
spreadsheet here.
iron condor, but I don't know if you're talking about that.
I think I don't remember what we did. We either did a credit spread or a reverse iron condor. Tesla
I'm pretty sure it
was
was the iron
here.
condor, and
Yep. Pay
we got
1070,
it.
grab $13. Yeah, that's what it was. So I maxed out profit at 15. Now it's trading. I mean, it would be maxed out. It'd be maxed out at $15 by now. But I took the trade the day after earnings. So earnings comes in day after earnings. I'm trading for $13.10, $13.30, $13.40. I just moved everything to $13 and got stopped out there. So I made, $2.30 net, which is around that 20 to 25% take profit, high probability. Fine with that. So it was cost effective to me, and just a trade. So do I do anything at Tesla now? No, I don't care. I mean, it was an earnings play. I'm glad to see Tesla wasn't beat up. What's kind of nice is all my credit spreads that I still have a bunch of 160 and 155s. Those are actually doing great. So that's now, not even a threat for some of my credit spreads to be. They're now, all out of the money, and they'll finish with full profit. So let's do. I forgot what we were talking about
You
here
want to look
on.
at Apple?
Sure.
Because they are reporting Thursday.
That's Thursday after market. Yep.
From what it looks
Somebody's asked
like,
for FRT. I'll do FRT before we're done. We got a couple more minutes. Apple
okay,
is so
their
Apple.
earnings doesn't tend to move it too much.
Agree. And so here's what I'll talk about with Apple. Let's go expected earnings. I'm sure it's single digit. Yep. So this is not going to be a big volatility move. Apple's essentially seen as, I know it's mega cap and I know it's the largest company in the world, but it's kind of a safe haven. It's been that way for a while. It's a company with super big cash reserves, and obviously tech and innovation is important. And I'm sure they're going to have some positive news to get them out of the rut. They've been talking with China a lot more recently, which I think is why they dropped so aggressively early in the year. So I think China, like resuming conversations between Tesla, China, resuming conversations between Apple and China, probably good for longer term growth and having that kind of that multinational exposure. So here is an earnings forecast for Apple. 4.1% is the expected move, and you can see how consistent this is. 4%, 4%, 4%, 6%, 5%. So 4.1 is totally fine. And let's go post earnings. The stock is trading at 174.91 right now, which, by the way, we opened up with a pretty big gap. So I'm not sure what made Apple gap from 170 to 175, but it is what it is. I mean, that's the week so far. We're trading at 174.88, 4.1% expected. So 4.1% at a 174.84. So we're looking at Apple making like a $7 move. $7 to the upside brings us up towards 181 to 182. $7 to the downside brings us back down to 167, 166. If we have a big move on Apple, I think, if Apple goes $10 this week or more, that's a big move because that's, 1.5 times the expected move. But if we look at it from the technical side, yeah, this little floor that we had at 180 could certainly offer some resistance. We could, have positive earnings, get us up to 180 and then fade that back down. Apple could then be stuck in some sideways movement. The one thing that would drag the whole market up, if Apple gets to the highs, Frank, the whole market's going with it, man. I mean, if Amazon was a miss and Google and Microsoft faded back down and Nvidia, like if everything dropped and Apple still went up to all-time highs, that's enough to stabilize the entire S&P. So I think that's what makes earnings so crazy is we have big companies like Amazon, big companies like Apple. If they just have remotely solid price action or positive price action. Obviously, earnings helps that to be a catalyst, but they're big enough that they can move the entire market. So
Yeah. Well, I guess we'll see.
we will see for sure. Yep.
I'm not convinced that it will move too much just on earnings, but you've seen periods where they beat earnings and just have consecutive days of upside, like going
Yeah.
from 160 to close to 200.
And I'm gonna go back to this, man. I mean, this right here, when we had overbought with divergence all the way up in the SPY, having one correction is usually not enough, right? Like one correction is usually not enough. So I think that this market still doesn't take out the highs. If we're going to come back down to revisit lows, high, low, lower high, lower low. This might take a couple of weeks, but if I was going to put a probability on direction, I would say that the probability is we revisit the lows before we break the all-time highs. I think that's a pretty safe forecast for me right now. Now, if I'm wrong, I'll accept it, which is how I'm positioning the way that I did. If I'm filled up here, if I'm filled down here, I'm still going to try to make income and generate profits. But if I think about this where we are structurally after having such a ridiculous rally, also that's a completion of a fifth wave. If we're going to go 1, 2, 3, I think we retest lows or get into some more corrective territory before this market justifies, breaching or running with all-time highs. That's
Yeah,
just my thoughts. So
I'm with you as well. I
yeah.
I don't think that correction was over. I think it's the 5100 on the SPX, which I guess is 510, 515 on SPY,
Yep.
and testing that 50-day. I don't see it going back up to the highs, but the market does whatever it wants. So
It's true. And we're
it's
sitting
probably
right here for the week to start out on a Monday with a Fed week and all the earnings. We're sitting right in the middle where we could go up to test the high, we could go down to test the low. That's an equidistant move, right? And at the
not
end of it,
improbable.
yeah, it's like at the end of it, it doesn't break the highs, it doesn't break the lows. It's just more indecision with a ton of volatility. So that's a very likely scenario this week with just lots of earnings, Fed, news for the US, a lot of catalysts that, ultimately give the market traction to go beyond. So, but like I said, I just don't think that we have the juice to break the all-time highs and just go crazy, unless
The
this market's just pure Goldilocks. If it
the
is,
one
then
thing
yeah,
I would push back on
okay.
is when you say you wouldn't want to see it break the lows or you don't see it breaking the lows. I feel like if we have an explosion to either side, say it's a bearish move,
Yeah,
that thing can really drop in a short period of time. So
for
taking
sure.
out the lows seems more probable than taking out the highs or busting through the highs as hard as it would the lows.
I agree with that. I agree with that statement 100%. And that would be so. And here's another reason. If you take a look at the kind of the velocity that we broke with on those sell trades, I mean, if we breach the lows, I would do nothing more than this. So we high, low, lower high, lower low. I would measure that corrective move. I would see how technically obedient it's going to be. If we measure symmetry, I would look to see if we came all the way back down to there to hit symmetry, hit these all-time highs. I'd still be interested in looking to buy into that fall, because that would be getting to that 8 to 9% correction zone.
Of
10%
giving
is kind
back
of a big,
everything from this year.
yeah, it would pretty much erode all the gains for this year, which would kind of suck, right? I mean, to be off to such an easy start for Q1 and then have it all get taken away in Q2. That being said, though, you still have the rest of Q2 to finish out June. You get into Q3, Q4. Again, we don't know what it's going to do, but ultimately and inherently, the market is trying to go higher. And companies, I mean, look, you have so much money that's still able to participate in the markets. You also have companies that are getting stronger, stronger, and probably focus way more on cost savings now, because the one thing that AI can bring to the table is cost savings. You can do more with less, right? If you have a company of 10 people or 100 people, it's probably a 5x or 10x multiple of how much productivity that company can now have. So, and I've listened to a lot of reports and read about this stuff. I mean, the the idea of cutting jobs and AI is going to take all these positions away, it's not necessarily that, but it's more like companies don't have to be Apple anymore. You don't have to have a company that's going to be a $3 trillion market cap. You can have a company that has a $1 billion market cap, which is small in the say, from the perspective of these mega cap stocks, is tiny. but you can have a company with, 50 to 100 employees that are still making billions of dollars because of AI, because of possibly the evolution in generative AI. So we don't know what that looks like, but as a supplement to productivity, I think that companies can do more with less. And so there's all this money being spent on the infrastructure, which is why Meta got hit so hard last week, because they're going, kind of like they did all in on the metaverse. They're kind of going all in on AI right now, and it could pay out. It could not. Who knows? And I mean, honestly, man, for this conversation, I am looking no further than this week, right? Like I'll trade what I trade. I'll see what makes sense this week. I'll try to position so I can make money up, down, sideways. Take a couple stabs at earnings because we have lots of them. And when the dust settles on Friday, hopefully we're having this conversation and, I'm up a couple bucks. That's all I want to do.
Yeah. Same here.
So
I'm just seeing, I'm feeling the volatility moves this week.
Yep.
So
yeah, I think it's going to be a noisy week. I think at the very least, expect a lot of noise and volatility. You could be up one day, down the next. You could be down one day, up the next. So if you're trading short term and you have some profits, like Nick said before he left the session today, it's a good idea. Especially if it's short term, profits in hand, I would take it. And that's certainly what I'm looking to do around earnings. If I take a trade, Amazon for tomorrow, and by Wednesday I'm in profit, I'm probably just going to take it. If I do something on SMCI or MicroStrategy or Coinbase or Apple, even on Friday or on Thursday to Friday, if I'm up profit, I'm probably just going to take it, and I can just take a sliver of profits, and let's say it adds up to $5 for the week, $10 for the week. If I'm doing that on 10 contracts, it's a pretty good week.
yeah,
So yeah, that's all I need to do.
sounds good.
All right, dude. Well, hey, let's you and I stay in touch all week. I'm sure I might be back onto the A1 sessions. I got to jump into my trading room now. We're gonna start pricing out some options, so I'll keep you posted on all that stuff. But I want to get those SPX and NDX trades in for me, just in case, and I'll put those fills. I'll probably look at the SPX getting filled at 50 to 55 cents, and the NDX trying to get filled at 75 cents to $1. I'll let you know. I'll send you a message on that.
Okay, sounds good. Thanks, Chris.
Okay. All right. Thanks, everybody. We'll see you soon. Take care.
See y'all.
Our Edge Finder anniversary sale is almost over. If you want 40% off the Edge Finder, the absolute best deal of the year, don't wait and head on over to a1trading.com to chat with one of our representatives live right now. This is the biggest discount of the year, and we have so many new features to share with you, like our Smart Money Indicator that directly compares COT data and retail data against each other, or our brand new data scanners with even more useful information and accurate scoring than ever before. Now is the perfect time to get this powerful trading tool because the 40% discount won't last forever. Celebrate the Edge Finder anniversary by grabbing yourself a copy today on our website, a1trading.com.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. And before you go, make sure to take advantage of our massive discount on the Edge Finder for our 2nd year anniversary. Links are below. From all of us at A1 Trading, have a great day, and we'll see you next time. Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. And before you go, make sure to take advantage of our massive discount on the Edge Finder for our 2nd year anniversary. Links are below. From all of us at A1 Trading, have a great day, and we'll see you next time.